Okay, so what I plan to do is a whistle-stop tour of BM, run through who we are, what we do, why clients are attracted to us, where does our growth come from, and how do we expect to continue that growth pattern that we've seen. So this is what's known as an infographic for all of you who are into marketing. And what I'll attempt to do is take you through who Brooks Macdonald are by jumping through all of these to keep you interested. And then at the end of it, you can tell me if I've actually missed any of it out. Who are we in short is that we're an integrated wealth manager specialising in private client investment management, both on and offshore. We were formed in 1991, looking at a niche in the marketplace. Back in 91, as most of us will remember, it was a very commission-hungry environment in the financial services world. So we set up as a fee-based entity. In 1995, we were asked by a financial advisor to work with them looking after their clients' assets in the same way that we looked after our own clients' assets. And indeed, at the same time, we started our trainee investment manager programme, which still goes on today. The first trainee that we took on in 1995 is Nick Holmes, who's now the managing director of Brooks Macdonald Asset Management. Now, we've got 88 investment managers, just to give you an idea of how well that trainee system's worked. 31 of them are now within that 88. So 31 and 13 is 44. We've had 49 go through the process. So we've only actually lost 5 trainees over that entire period. And that's really important and something we'll come back to in due course around stability. We listed the business in 2005, so 11 years ago this March. Reasons why we wanted to list were for profile raising, which has definitely worked, and to raise some cash so as we could make some acquisitions. The acquisitions didn't really happen, but the profile raising certainly worked. And what it effectively did was allowed us to say, as we do today, that we sold the business in 2005. So we get a lot of people saying, who are you going to sell to? There's a lot of big acquirers out there. We say, no, we sold the business 11 years ago, but we still control the business. So we, as in employees, directors, founders, own 20% or thereabouts of the business, which allows us to maintain control of it. We've actually got 466 employees, and about 2/3 of them own some stock in BM, which we think is A, powerful, and B, very important. Also in 2005, we launched our first regional office. So Hampshire, we were in London already, we launched Hampshire in 2005. There's now 12 regional offices, including 2 in the Channel Islands, running 7.82 billion of FUM as per the announcement yesterday. And that's predominantly through 3 service-led propositions, which I will come back to in due course. But firstly, just looking at the group, Brooks Macdonald's made up of 6 different companies, and I'll very, very quickly run through these. Asset management business is private client discretionary investment management. The financial consulting, it's holistic financial planning. So a client will come for be it insurance or pensions advice. But the key to the asset management business and the key to growing FUM is that they recommend the investment solution. And we work with our own Brooks Macdonald Financial Consulting, and we work with a lot of other financial advisors as well. And I'll come on to that because that's a key area of growth for us. Funds, we run multi-asset funds into the advisor space. We run specialist funds into the institutional space, so selling to our peer group. Braemar is property management, so it's mixed use. So you'll have Beetham Tower, for example, which we manage in Manchester. It's got the Hilton in it. It's got residential inside it as well. The Shard has Shangri-La and residential and retail space. And we don't manage that, but we'd like to manage that. That would be good. Investment services powers the back office in the asset management business. And BMI is an area of significant possibility and growth. And it contains an asset management business and an IFA business, but out of Jersey and Guernsey. But looking far wider than that. And I will come on to that in due course. So the core services, if the asset management business is the driver, and I'll come on to how much of the business it is, but what do we offer within asset management, both onshore and offshore? And the key is that we have one investment process. We don't have lots, we're not trying to be all things to all people. Very much we're one process, and from that fall the services that we provide. So looking at the three, bespoke portfolio service for us is £200,000 and above. It's a personal service. It's tailored to you. You're sitting down with an investment manager and your advisor in most cases and deciding what's right for you, and then we construct it. But you don't stop on that day. You continue for the rest, hopefully, as a client, for the rest of your natural days, reviewing, making sure that it's still applicable to you and meeting your objectives. The second service is managed portfolio. It starts at 20,000. At 20,000, 50,000, 100,000, it's impossible to provide a bespoke service. You have to be cheating to be able to do it. So this is a range of portfolios, still in your own name, but it's not bespoke to you. There might be 5,000 people in one of the 10 strategies which are on there. Then we have a multi-asset fund service as well, which is a replica of the MPS, but in an OIC structure, which has tax benefits for private individuals. That's a pretty quick run through those three core services. Now, important to you is where's the money being made? So funds under management at the moment sit 75% in the onshore asset management business, 16% offshore, and 9% in funds. And in which service do they sit? Well, it's 80% in our bespoke service. So you could easily say, and you'd be right at this point in time, that UK bespoke is the core of the business and it's where the revenue is being made. Yes, it is. That is coming down a little bit. It is diversifying a bit more as financial advisors go into models through MPS and fund of funds. Now, let's just pretend for a moment that you're all potential private clients. You've all got to decide, how are you going to get to market? How are you actually going to make your investment decisions? Are you going to make them, or are you going to ask somebody else to make them for you? And we think there's 5 ways to market. And just running through those 5. Number 1 is DIY, which I think you guys and girls probably know quite a lot about. And that might be through your own nominee, through Fidelity Funds Network. Lots of people buy their ISAs through there. Hargreaves Lansdown, the Vantage platform, for example. Nutmeg, if you want a little bit of advice as well. And we think that these guys will do pretty well. We think there's going to be more people that actually want to invest their own money, and at least with a proportion of it. So we think that'll work. Direct is, if you remember in years gone by, we've had big ISA placards out there next to all the train stations, by New Star, by Henderson, by M&G, etc., etc. They've really died a death, and the direct is dying a death. So you see these companies are now coming to us because they view the client as likely to come through a financial advisor to a DFM, and a DFM will buy from them. So direct's kind of dying or dead. Vertical integration is really interesting, and as investors, you'll all look at SJP in particular here. But this is basically where, within their model, they can do everything. So they can give the financial advice, they can recommend their own investment managers, they can recommend their own platform. They actually don't need to go anywhere to recommend something. And that can provide a very good service for a lot of people. Old Mutual have done it by buying Quilters, by buying Intrinsic. They bought the Scandi Celestia platform, well, they had it in-house anyway, and they've got their own fund group. So they really can do everything in one place. We believe that there's a place for it. It'll do very well. So if we're looking for ups and downs, DIY, yes. Direct, no. Vertical, yes. But the best quality service that any individual can get, in our opinion, is by going to a professional advisor who then recommends, if it's right for you, to use a discretionary fund manager, and that's where we sit. We think that's aspirational. We think it's the highest quality of advice that any individual can get, and that's where we want to be, in the highest quality area. I put insurance in because it's an interesting area. There's a huge amount of money in managed funds in insurance companies and with profits funds, big generic things, and that's where we're seeing a lot of money pull out from. So you're seeing money come out of those generic pension managed funds and into self-invested personal pensions, which are being managed by professional people like us. So that is definitely on its way down, which is why you see Aegon have got a separate business in Cambs for investments. Standard Life have got Standard Life Investments. The insurance company is over there now, investments over there. So why do clients come to us? Well, there's lots of obvious reasons, but these are 4 which I don't think you'll get day to day when you go and ask the 220 other DFMs who sit in the marketplace. Stability in the first instance. We run the business with a barbell approach. We aggressively go for growth, but we do it with no debt on the balance sheet. We've never had any. The plan is never to have any. In 2007, we get slated by the analysts because you've got to have debt. You could really drive this business. 2009, we're geniuses. So, it changes year by year and analyst by analyst. So, but we go for barbell. So the business is very, very secure. Then you've got to have the staff. In private client world, you've got to have the staff there to look after the same people for a long period of time. I showed you earlier with trainees, we lost 5 trainees in 21 years. Investment managers, it's a very similar figure as well, although people will retire once in a while. So for your client who arrives, they want to deal with the same business and the same people in perpetuity preferably. And that's one of the things we're trying to provide. You've also got to provide very high quality performance with a robust investment process behind it and an explainable one, an understandable one that a client can say, yes, I get it, I understand what I'm going into, and they can come back to you every 6 months or every year and question you about it, and you have hopefully a nice discussion about it, because thankfully our long-term performance is very good. Long-term performance is what's important. You'd then say, well, your short performance must be awful. It's not, it's really good as well. But I can understand why you might think that. Personal service, again, continuity, you want to use the same people, have the same faces looking after you time and again. That's absolutely key. And also, it's got to be personal. So in our bespoke service, investment managers are not allowed to have more than 140 or so clients, because we think after that you become a number. And that's not what we want. We want them to know where you went on holiday, kids, grandkids, so that actually you can enjoy a nice relationship over a very long period of time. And then it's the culture and ethos of the business overall. So putting the client first, okay, clearly. I say clearly, not every business does it, but we very definitely do. Run the business as a big family, admittedly, 466, but we run everything in small teams. So you always feel that you're part of a smaller family group, but do it on a professional basis. And if you manage to do all 3 of those, then you keep clients for a very long time. But the key to all of it is consistency. So we try very hard to have high performance numbers, good service, year in, year out. If you do that, you'll be successful, which we have been. Where does the growth come from? I've mentioned professional advisors once or twice in this. And 88% of our business comes through the professional advisor channel. Now, as you see there, this is our last full year results for June 15. We've trading update yesterday, and we announced on the 17th of March. But we worked to the end of our last year with 775 different advisor firms. Okay, so that was up 16% on the year. It's up 3 times over a 4-year period. And we see that as continuing, and we'll come back to why. In terms of the market, there's 14,550 firms, or there was at the start of 2015. We reckon we want to work with 2,500 of those. Strategic alliances won't necessarily mean anything to you. It's where we get deeper with a business, get to understand them, we commit more to them, they commit more to us. And over a long timetable, the 2 businesses really get to know each other and trust what you're doing. And we've found that works very well in terms of bringing on larger sums of funds under management. And internationally, and this is really key, expanding jurisdictions as regulation allows. Regulation, we had something in the UK called RDR, the Retail Distribution Review, which changed the landscape here. Now what you're finding is that regulators overseas are following the same model that the FCA brought in. And we're going and following that model. So the model encourages financial advisors to outsource to investment managers like us. And now we're seeing that in South Africa. So we're in South Africa a lot, beginning to see it in Singapore, seeing it in the United Arab Emirates as well, and that we believe that will continue. So there's lots to go for. The opportunity out there, right, so quickly, demographics. I'll just pull a couple of stats. 13,350 people over the age of 100 in 2012. In 2112, that'll be over 20 million if the population of this country doesn't increase. Okay, that's the bare stats that are predicted. Now, 100 years is a long time, I get that. But this is a steady trend which is happening over that time period. So the number of people who are going to be alive, who are going to need bigger pots of money to retire on, is just going up and up and up. So the very base, which is people, the population is expanding significantly. Add to that, back in the day, companies used to look after you. They'd contribute to your final salary scheme, and when you retired, they carried on paying you until you died. It was absolutely fantastic. That's changed now, so they're closed. You know, they will run out completely in due course, and it's all defined contribution, i.e. they're not looking after you in the way that they used to in the past. Equally, the government are passing responsibility to you as well. Okay, they're saying you need to look after yourself. So there is one person who's going to do this in the future, and it is you individually. And what are you going to do? Most people are going to get advice, I believe. Changes to pension rules have been fantastic and awful in one go. Great, because the freedoms mean that everybody should have a SIP, frankly, and everyone should have 999,999 quid in it in an ideal world. I recognise that's not entirely possible. Equally, it's not so great for us because you're only allowed to contribute £3.50 into said pension. But that's not true. You know, it's up to £40,000, and we believe that that and an ISA will be the staple diet for saving going forward. Inheritance is quite an interesting point because we're seeing baby boomers start to die, and they're passing a lot of wealth because they've been in this fantastic era of wealth aggregation, and they're passing to a group of people who we think are learning how to save because they don't have any choice. They've got to learn how to save, which is going to lead to a lot more people with a manageable pot. If you think that our BPS service starts at £200,000, you know, if somebody on reception wants to retire on £20,000 a year, they need a £400,000 pot. Okay, just to give you an idea of the figures. Every single £400,000 pot we could manage on a bespoke basis. Okay, so onwards and upwards. There's a lot of words on there. I apologise for that. But let me pull out a few. Barriers to entry. We think that to offer an end-to-end service in our area now, you need to have 3 billion under management. We're at 7.8, and I do think that we've been riding the front crest of this wave. Below that, you'll see a lot of people trying to go through a consolidation phase, and we know that there's a lot of people trying to sell out there. Advisor community is growing for the reasons which we talked about. The trend towards outsourcing to investment managers. You know, there's an understanding that selecting the right solution for somebody is not the same as managing that solution into the future. They are two completely different skill sets, and that's becoming clear now. Now, we like to show this one. Everyone likes a bottom left to top right graph. So we've been very successful in what we do over the last 11 years, you know, and we're pretty clear that the barbell approach that I talked about earlier of no debt but aggressive growth is working. If you have a long-term attitude to your business, you're not afraid to invest in it, you know, then you can believe in what you do. And I think these are the results that hopefully you will see, and you know, that we've seen, and we believe we'll continue to see. The second line from the bottom is the key one. That's the increment. How much are your funds under management going up every year? And compared to the bottom one, we want to see a 10% difference plus between the two. That is our net organic growth rate of funds under management, so after markets. And we think we can do more than 10%. And to give you an idea, Bruins came out today with 4.8%, Rathbones came out last week with 3.7%. Our quarterly rate this time gave us 11.7. That would be exceptional. We did 9.8 as a year last year. If we do over 10 this year, that would be great. So, outlook and conclusions. Demand looks great for our industry over the short, medium and long term. We're focusing on being that consistent player. There's so much change in our industry, but we're not. Yes, we're evolving and we're developing IT, etc., but we're not changing the principles of what we do, and working with professional advisors around the globe. So we are. This is straight out of the RNS yesterday, but we're cautiously optimistic about our ability to continue the success that we've had over the last 11 years. Now, there are some appendices. That is for bedtime reading, but just to give you a guide, this is our bespoke portfolio performance over the last 5 years. Where it's white, it's weak. Where it's not white, it's really good. So over 1, 3 and 5 years, we've underperformed the group in 2 out of 15 periods, which is good. Revenue and profits growth, talked about bottom left to top right. That's what you want to see. underlying EPS, and dividend growth, bottom left to top right. It's good. External shareholders, Lion Trust are the biggest shareholder, 17.75%. That's quite a lot. So I thought I'd cover it off now. Anthony Cross bought into us at listing in 2005. He was the biggest shareholder then. He is the biggest shareholder now. It's just Lion Trust have done really well. So he's got more funds in his funds, and that's equated to buying more of our stock. You'll see that's the top 5 high-quality individuals in our sector, basically, in fund management. And then awards are great, so it's great to put them up there. But you might not win them next year, but we did last. Questions?
Are you doing anything about robo-advisors or any blockchain solution for the back office?
Okay, so I think there's 2 questions in there. The robo-advice piece, we've looked into it and we've decided that that's not our place. I think you need 2 things to do robo-advice. You need a lot of money to spend on IT to get it right, and then you need a big reputation. You need a brand to put out there as well. We don't like spending lots of money, and our brand isn't there yet. So our peer group, Bruins have done it, Investec have done it, Rathbones and us. Rathbones are big enough to do it, but I suspect Rathbones and us will stay out of that space. I mean, we've decided to stay out of that space. From a back office perspective, we're going through a big piece of work over a 2-year period, changing our whole back office. We've grown quite quickly, so we had a back office and about 40,000 other systems bolted onto it, and we're going to a back office, which we started in September 14, that should finish September, October 16. Yes, sir.
I'm very conscious that fees become very important, particularly when returns are low. Could you tell us more about the total expense ratio of the funds that you have, and in addition, what advisors' management fees you charge on top of that? Yeah,
of course. I mean, the TERs include, so total expense ratio of an investment. And we have a number of different investments, from our bespoke portfolio to our managed portfolio to the funds that we're running. And it will depend upon the individual client and what they're asking us to do as to what that total expense ratio will be. There are 4 parts to it. There's the DFM's charge, and our charge for bespoke averages at 91 basis points and averages at 50 basis points for our managed portfolio service. There is the platform that underlies it, which in the vast majority of cases is going to be us. Then you've got the underlying funds, and we buy direct equities, we buy structured products, we buy open-ended and closed-ended, which is a lot of jargon, but there's a lot of different types of investment out there, and that averages at about 0.5. And then you've got the underlying financial advisor who's recommended the client to us, and they come into this as well. And what we try and make sure is that the whole thing gets to under 2%. That's what we aim for. And we think that once you get towards 3, and so I won't knock the opposition, but some of them are charging more than 3% in total. We think that that's, particularly with low returns, as you say, that's eating into it, and the compound effect of that's horrific.
You mentioned that you're trying to do business in the Far East, but I think there's some companies that charge a lot more than that. I think there's another quoted company that are sort of charging 7% or something like that on
initial fees. Yeah, well, we charge 0 initial.
But is there more scope for higher charges in less sophisticated markets?
There are, but we tend to be working with the financial advisors who have come out of the UK and are quite savvy as to what they should be giving, because they know they can walk into somebody's home and go, we're going to do the whole lot for 2, knowing that someone's just walked in and said we're going to have 7 up front. So there's a slightly better margin internationally, but it's not as big as you might think. Yes.
How many clients does the average wealth manager in your company have?
Cool. Well, we max it out, as I said, at about 140. We've got, at the moment, we're not taking on lots and lots of trainees because we've actually got quite a lot of capacity in-house. So I don't have the figure. If I was guessing, I'd say 110, 120, but across 88 investment managers, that's quite a few. Yeah.
What are you finding with the demographic of new customers? Is the age going up, age going down?
Yeah. Our demographic has always been lower than the norm in the marketplace, and I suppose it's because of where the distribution channel. You know, a lot of our peer group have got inherited or old wealth, if we'll call it that, and it can be old people as well. Whereas financial advisors tend to be working with people who are accumulating. So our average client age is early 50s, whereas it could be a lot older than that. So coming through the door, generally it's people who get into their 40s, like me, and who've got different pots all over the place, and they say, I don't know what to do with all of this. And actually I'm not comfortable looking after it anymore because I haven't got that long before I want to use it. So they'll go and find an advisor, and the advisor will send them to us. Go on.
Very nice slope in your dividend increasing over the years, but it's still well below 2%.
It is. Well, the price keeps going up. The cover is 3. We have a progressive dividend policy, so that will keep coming down. What we don't want is ever to be in a position where we have to say we're going to cut it, because that's bad. So it's progressive. The cover will come down, which means the dividend should continue to go up. Our problem, actually, which analysts ask a lot about, and this isn't an analyst presentation, is that we've been paying for a few acquisitions over the last few years. Not in 15-16, but in 16-17, so July this year and onwards, we're going to start generating quite a lot of cash. So we're talking to people that, do our major shareholders want us to invest for organic growth? Do they want us to increase the dividend at a faster rate? Do they want us to pay specials? So that's the conversation flow that we're going through at the moment. Personally, we're a growing business, and I think there are opportunities out there that we can take our net organic growth rate of 10% and push it.
High class problem to have. Well,
First world problems.
thank you very much, Andrew.